So we're going to talk about scalping today. And first, we should actually talk about what scalping is, because originally scalping was a term used to define trading that just captured the spread, so buying the bid and selling the offer. But over time, the term has been more widely used, and now people use it to describe lots of different styles of trading. And I guess the reality is that the word scalping doesn't mean that much anymore. It's kind of become overused, and it's become a matter of opinion of what defines a scalp and what doesn't. But in this presentation, I'm going to stick to trading techniques.
Peter, can I interrupt you for a second? Can you put a little louder? A couple of people would like it, to hear you loud.
Absolutely. Let me just adjust that. Okay, 1 second. Okay, is that better? Oh, wait there. Okay, is that better?
That's much better.
Okay, good. Okay, so in this presentation, I'm going to stick to trading techniques that are closer to the original definition of scalping. We'll start out by looking at techniques that focus on capturing the spread. And we will, of course, talk about techniques that grab more than one tick, because even a market maker looking to capture the spread will take more if it's available. So it's not as if scalpers are taking trades and intentionally leaving money on the table by just taking one tick. It's just that scalpers are working from a different perspective. So today's webinar is more about the perspective, the decision-making process, than the amount of ticks profit or loss. And the perspectives really are different. So a longer-term day trader might be looking at support and resistance, trying to figure out what sort of day type it is, what the MACD is doing, where the value area was yesterday, and so on. Scalpers, certainly those in their purest spread capturing form, simply do not care about any of that stuff. So with a different perspective, they make decisions based on different factors that are often very short-lived and that change minute to minute. And not only are perspectives different, so are the win rates. So in fact, the win rate of a scalper is often what many traders would consider outrageously high. I know one scalper whose statistics are 85% wins, 10% scratches and 5% losses. Now, of course, these statistics don't include bids or offers that get placed but never get filled and where the market leaves without you. So missed trades are a big part of scalping. Now, if you come across a website promoting you an 85% win rate, you'd probably think that was a scam, and in all probability, you'd probably be right. But we're not talking about risking 5 ticks to make 20 ticks here. We're talking about very small targets and trades where there's a momentary high probability opportunity which is very short-lived. So if you considered typical retail commissions on the S&P 500 of $4 a turn, then losing a single tick trade will cost you $16.50, but winning a trade would get you $8.50. So of course the win rate has to be higher. It wouldn't work otherwise. And it also makes sense that you use a deep discount broker, get on some sort of program with the CME, such as their International Incentive Program, which knocks about 66 cents off the CME fees for the ES. That all will absolutely help with scalping. But this higher win rate does not make scalping better or scalpers smarter traders. It just means it's a different way to trade. So the goal today is to give you some insights into what scalpers do and how they make decisions. And we'll start off with the smallest trades, and as we go through, we'll look at those trades where we can get more ticks. Now, why scalp at all? Why is it that if you went to a prop firm as an intern trader, they would start you off as a scalper? Well, first of all, let's consider the techniques that fit the typical goals of most retail traders. Those that get you into trade you can sit in for, 50 ticks on crude or 8 points on the ES. The most popular techniques right now seem to be market profile and volume profiling techniques. And these are methods of attempting to determine how a day might play out and where the extremes of the day might be. In other words, trying to guess where the market will go that day. So let's say you read Jim Dalton's books on market profile. There's a lot of stuff in those books to absorb. So let's say you read the first book in a week, which would be easy enough to do. That would be a lot to keep in your head when you actually opened your trading platform the next trading day and attempted to apply that information. So there's two aspects to applying these techniques, and one is actually learning the techniques bit by bit and applying it so that you actually retain the knowledge, and then the other is experience the different day types so that you're able to come up with suitable scenarios before a day starts. So it's not that hard to look at past market activity, long-term market activity, look at what's happened over the past few weeks, then days, and come up with some tradable scenarios. You just have to do it a lot to get good at it. And the problem, if we can call it a problem, is you can only plan scenarios and then see how that day actually unfolded one day at a time. And it's the same for other techniques such as volume profiling. You might see someone come up with a couple of scenarios each day and see that they're quite consistent in having some of those scenarios play out. And this is more of a reflection of their experience than their theoretical knowledge. So that's somebody that has experienced a lot of days. So let's say every day you decided to write down potential scenarios. How long would it take before you started to get good enough to plot out tradable scenarios with some consistency? Now, it's obviously going to be many months because you need to do it across different market conditions. So maybe 6 months to a year is by no means an extreme estimate, considering you just get one estimate per day. Which brings us to one of the main benefits of scalping and the reason it's the starting place for most prop futures traders. So instead of plotting one scenario a day, you're plotting scenarios over and over again throughout the day. So at extremes, this could be potentially hundreds of scenarios, but even lower frequency scalping, you'd still be looking at 20, 30 tradable scenarios a day. So in essence, scalping is a skill you develop over a shorter time period because you experience more scenarios and trades each day. So you still have all the same demons to exercise though. So if you can't exit a losing trade, you're still going to have to overcome that issue. But the bottom line is you can get profitable scalping while you are still focused on your longer term gain. So there's no need to throw away the Jim Dalton books. Longer term trading skills are still of value. It just takes a bit longer to get to profit, and you should expect that. And then of course there's a comfort zone. So with scalping, you are in and out of the market very quickly, and many people are just more comfortable with less time in individual trades. And this sort of trading is just going to basically suit some people more than others. Now, no discussion on scalping would be complete without considering the tick values of the instruments you trade. So here's a look at the US Treasury futures on CBOT. So we can see that the 5-year note here has the lowest tick value of just under $8 a tick. So the Treasury bond and the Ultra Treasury bond have the highest with tick values of 31.25 a tick. So obviously this is going to make a huge difference to the impact commissions have on your trades. So you can get retail commissions on these instruments of around $2.60 a turn all in. So that's about 30% of the tick size of the 5-year note, but about 10% of the tick size of the Treasury bond and Ultra Treasury bond futures. So if you're trading for a tick or two, it makes a lot more sense to work on higher tick value markets, because basically you can afford to be wrong more often. Now, of course, as we discuss scalps with larger targets later on, this becomes less of an issue, but it makes a lot of sense to look at markets with larger tick values. So let's take a look at the markets themselves. Now, bear in mind, this was 4 a.m. Eastern time, but there's a lot of Asian, European traders trading these markets. So what we can see left to right, we've got the 5-year note at 7.25 a tick. We've got the 2-year note really, really thick at 15.63 roughly a tick. And then the next two, the Ultra T-bond and the T-bond at 31.25 a tick. Now, not only are the tick sizes different, you can see they differ in volatility too. So at one extreme, we've got the 2-year with thousands of contracts level. So if you put a bid or an offer in here, you could end up waiting 45 minutes for a fill. Now, obviously, the more liquidity there is in the market, or the more bids and offers there is in the market, the less volatile it is. So when we look at the two markets over on the right, we can see, over on the left, you can see the 5-year note has less liquidity, so less bids and offers, and a larger range than the 2-year note. So depending on which techniques you use, you will find that makes that market more or less attractive. So on the one hand, you can have more trades a day on a more volatile market. There'll be more opportunities. But on the other hand, you can trade a lot more size on the thicker market. And again, it really comes down to your own style, preference, which sort of market you choose. Now, if we consider the two markets on the right, they've both got the same tick size of 31.25, but you can see the Ultra T-bond is a lot less liquid. There's less bids and offers. So that makes it more volatile than the Treasury bond on the right. And my preference personally would be to stick with the Ultra Treasury bond. So your chosen market initially, and I would advise only starting with one, should come down to a mix of attractive fee structure, a volatility profile you're comfortable with, and the available of fairly reliable correlated markets. Now, being in the position I'm at Jigsaw, I get to speak to a lot of traders, many of them professional traders. And one of the things I've yet to see is a professional futures trader that only looks at a single market. Now, there is a bit of confusion about this because some people think that looking at multiple markets means somehow being able to read everything that is going on with every one of them. And that is simply not the case. So what we have here, we have 4 depth and sales, or 4 domes. And a lot of people will look at this and immediately they run screaming from the room because, oh man, I don't like numbers. I want to trade off pictures. So forget for a minute that there are numbers on here. Just look at this black line in the middle. That's the center line. Now you can reset, you get this on most good domes, and you can recenter your dome at any time, and the black line then becomes a reference point, from the time you recentered, that you can easily eyeball. So without looking at a symbol number, if you glance at this, you can see all markets are trading above their center line. You can see the thinner markets are leading a little, which should be what you'd expect as they are more volatile. And at a glance at this, we can see we have upside momentum on all 4 markets. Now, you didn't have to read a single number to see that. So we're not talking about watching every tick of each market. We know there are relationships between markets, and we know that arbitrage traders, many of them now HFTs, are stepping in when markets get out of line. And we also know markets can speed up and slow down. So when we look at correlated markets, we're looking primarily for the level of overall activity. So are the markets directional, or is each market doing their own thing? So for example, you often see days on the US indices where the Dow is moving up, the Nasdaq's moving down, and on those days the S&P 500 tends to be quite slow and range bound. So there's no directional conviction in the market. So it's not so much that the correlation has broken down as much as there's just not a lot of interest. And then you'll see times like in this image where markets become directional, and we can see clear movement and momentum on all of them. So this gives you a gauge of commitment or excitement or overall market direction. And in addition, it does help you get into value-based trades. As generally speaking, we tend to value things relatively. Forget the markets for a second. If you're going to buy a house and you wanted to know if that was a good price, you'd look at the recent sale price of a similar house in that area. If you're going to buy a second-hand car, you compare that price of that car with the price of other similar cars to sell. So we value things relatively. Similarly, if you have correlated markets and one has gone up but the other hasn't yet, then potentially for just that moment in time, the one market could be considered undervalued. Now, obviously, you could argue that maybe the market that went up first is overvalued, but let's agree there's a value discrepancy, and if you get on the right side of that, you should be able to scalp out a tick or two fairly quickly. Now, a few minutes later, you find that opportunity's gone. You either took it or you didn't. The market moved on, and now you're looking for the next opportunity, and that is what scalping is. And one opportunity to the next opportunity, they generally don't have much relationship between them. Short 1 minute, long the next minute. Now, some of the more experienced prop traders are trading a dance between interest rates, commodities, energies, index futures, because they're so experienced and they understand how all these markets impact each other. Now, not everyone's going to get to that point, but it does highlight the value of understanding market relationships and how these markets do impact each other. And of course, these correlations do break down from time to time. The correlations can be inverse relationships too, where one market moving up sees another moving down, and it's absolutely fine to use inverse correlations in scalping. You know, looking for one market moving up to give you confirmation for the other market moving down, and also just for that lack of activity overall. Excuse me. Now, the first technique we'll look at is the one I know the least about, and we're going to call it the crocodile, because it requires the appearance of being asleep for hours until something interesting comes by. Now, I first came across this technique when I met a group of prop traders for coffee in Singapore. They were at a firm that was really flexible, and the traders were trading a large range of different instruments. Some were trading outright positions, some were trading spreads. They were open 24 hours, so some of them were staying there in Singapore, trading the US Open, trading right into the night. But there was one girl in the group that was trading this technique, and when she explained what she did, my jaw dropped, and the first thought into my head was, how on earth would you even stay awake doing that? And then the funny thing is, after the first time I did this webinar, I know a guy in a prop shop in Australia, and he told me he knows a guy who just made his entire trading career off this one trade. Now, we've already discussed that scalpers' perspectives are quite different, and that's the reason I wanted to look at this first. This is so different from what most people consider trading. It's the perfect introductory technique for this webinar. So here we are on the 2-year. We're in a slow, really, really thick market. It's 4 a.m. Eastern time. We've got an offer in for 10 contracts, and we are number 1,717 in the queue. So what exactly is going on here? Well, simply put, we are playing the queue position. We're keeping an eye on our place in the queue, and as we get nearer the front, we want to see plenty of people behind us, and at some point, when we think we have a chance of a fill, we'll put a bid on to exit the trade. So the idea is to get into a position with lots of liquidity behind you, and if you do that, you can cancel your offer if it gets a bit thin behind you. And if you get into a trade, you have plenty of time to get out at break even if the correlated markets start to move against you. Now, of course, we may presume that the queue is a bit like a queue in a supermarket, first in, first out, but that's not always the case. And whilst it's a bit beyond the scope of this webinar to cover all matching algorithms, there is going to be a link at the end of the video, to a video rather, that explains the different matching algorithms. So, for example, the 10-year Treasury note gives priority to the largest limit orders first, up to a maximum of 250 contracts. So even if you're the last to place a bid, if your bid is biggest, say you've got a bid of 1,000 contracts, when a market order comes in, you'll get filled first up to 250 contracts. Now the CME is changing the way we get queue information too. So instead of just seeing how many limit orders are in the market, we'll actually be able to see a breakdown. And as we all get access to that information through our data providers, people are gonna start gaming the queue. In fact, there's no doubt people are already gaming the queue. So, but anyway, just know that the queue is not always first in, first out. So obviously, this style of trading requires a thick market and an understanding of how allocation works on that market. So to me, this seems like a tedious way to trade. But nobody said trading was supposed to be exciting. It's just a way to make money. It's a business, right? So the 2-year Treasury on the US markets, the bubble on Eurex are about the same in terms of liquidity. So there's a couple of markets you could potentially play this game on all day, given an understanding of the matching algorithms for those markets. And so this is a US market at 4 a.m., right? Now, unlike the methods we'll look at next, I'm going to guess that not many people watching this presentation will go away and look into this one. But it does set the scene for understanding the paradigm shift required when it comes to scalping. Now, as I mentioned earlier, I prefer a thinner market. Okay, so that's less liquidity, mostly because I've got a short attention span. Now, we'll look at thicker markets in a second. So here we can see US Treasuries mostly moving up. And the reason for showing you this is fairly simply. If you're a position day trader, this trade here would be considered by most as a terrible place to go long. Okay, so if you look at the chart on the top left, we can actually see we're coming back to the day's high for a second time. So it's almost a double top on the Ultra Bond. But the thing is, as a scalper, you don't care about that at all. On a market like this, we'll likely be in and out of the market in less than a minute, sometimes less than 10 seconds. So the bottom line is that right now, right here, momentum is to the upside, and there's no evidence that people are coming in to play a reversal or a breakout. So right now, the scalp trade is to buy the bid and try and flip that out at the offer. It's basic market making technique. Now the trade numbers on the middle of these domes, just to explain what you're seeing here, has recently been reset. This kind of shows me what's traded at the levels last time round. We've also recently recentered the domes, but as you can see, even after the recenter, we've got a little bit of trade occurring and the market is marching up. Now at this point, I have to say, if you simply start bidding every move up, you will definitely lose money. So you can't expect to start doing this tomorrow and be profitable. But on the other hand, you shouldn't be losing a lot of trades either. So if you keep trading with the market, you won't have a ton of losing trades. You probably won't overcome the commissions until you start to understand a bit more about how the market you trade moves. So that means understanding what state the market is in. So is it starting to show signs it's slowing down or even speeding up? And that's something you can't gauge by watching a market for the first time for 5 minutes. You can't get a good feel for whether it's fast or slow today. You can watch a market for 5 days and start to get a feel for the changes in pace though. And the same thing for the related markets and how they tend to move together. You need to tune in to how they move together. And that is the only way you'll get to know if something exceptional is happening. So once you've chosen your markets to trade, found good correlated markets to watch, you'll have to spend time watching them to make sure those relationships are reliable, or if they tend to break down, or what happens when they gather momentum or revert to range bound behavior. So you need to gain experience. Now this is a thinner market. There's 6 bid here, which is good and bad. It's good because I'm at the front of the queue, and it's bad because there's not much behind me. But what this picture doesn't show is the attempts this market made to tick down they couldn't hold. So what happened was they kept pulling the bids at 87.07. The market would tick down to 06 and immediately would jump back up. Then it would tick down for less than a second. Someone would jump in, nudge it back up. And it looked like they were trying to entice people to sell, trying to make the market look weak. So not many contracts were actually trading. So it was literally they were pulling the bids, putting them back. It wasn't if there was a lot of selling going on, just bids pulling and then coming back in. So what I did, I sat there while I was watching that, and when they pulled the bids, I just clicked here, put my bid in the moment it ticked back up. So they pulled the bids, 86.06 was the inside bid. The moment it ticked back up, I clicked, basically trying to get close to the front of the queue so I'd have a good chance of getting a fill. So here I am, bidding a market with bid a market very at the inside offer, close to the high of the day, with a good QQ position. All markets are at their highs and no sign of weakness. Now at this point, or at that point, I could cancel the trade or get a fill. So you might put the bid on and then you might cancel it if you see sellers on other markets or even on this market. You might get a fill and see weakness in other markets and scratch the trade. And what happened in this case is we got a fill. So we had 3 contracts in a position and 31.25 a tick. Now at that point, I was not that bothered about the target. Okay, so at this point, I am not at all worried about taking profit. That's not what's on my mind at all. What I'm doing now is I'm watching the markets, especially other markets, to see if there's any sign of weakness, and if there is, I'll scratch a trade. So the only action I'm going to take is to scratch a trade. The target's going to take care of itself. I'm not worried about the target. All I'm worried about is, do I need to get out? So we can see that here 101 contracts have been added to the bid below us. 13 contracts have been added to this bid, and 89 contracts here have been pulled from the offers above. So these tell me what's added or pulled from the bids, and then the current trade columns here, they actually get reset when you get filled on the trade. So what you can see is across the board, there's been very little trading since I got into the trade. Now, a question a lot of you will be asking is, where's the stop loss? And the answer to that is, I don't have a stop loss. Now, that doesn't mean that I'm going to let this trade move against me 20 ticks and kind of cross my fingers and hope it comes back. It doesn't mean I've got some kind of 10 to 1 risk reward ratio to try and improve my win rate. It simply means that I'm not going to exit the position as a knee-jerk reaction to the market ticking down. I'm going to try and work an exit. So let's say the bid's broke and the inside bid was now 87.06, where we can see it right now. I've got 157 contracts bid. So the offer then, this side, would be 87.07, my entry price. So if everything else looks stable, I could try and offer my entry price and try to get out at break even. If the other market started to push down, if the other market started to push up, I would just sit on my hands with my offer there at 87.08. Because if everything else started to push up, I know there's a good chance the Ultra Bond's going to go up with it, which is another paradigm shift for this sort of trading. So we already said that it's a bit more about learning how your chosen markets move together. We have a slightly more volatile market here, so it will be more prone to wiggling around a little. So instead of panicking when the market moves a tick against us, you just keep a cool head and put that one tick down into perspective. Are the other markets still bullish? Should we work out at a tick loss, or are we quite confident the behavior we're seeing does not indicate a move down? You know, the market's going to wiggle around. Unless there's a lot of selling, the market's not going to change direction. After all, we're getting in based on our read of the market and our experience of how that market moves. And we're going to use that same read of the market and experience to manage the trades. We're not just going to get out on a knee jerk. Now, of course, it would make sense to have an emergency stop somewhere, 4 or 5 ticks below. That's sensible, but it's not something you have to do. So the bottom line is, with 157 contracts at the next price down, I don't want to exit my trade because one contract trades at that price, because that's what a stop loss will do to me. So if you know your market well and know how it interacts with other markets, you should not go into panic mode when the market ticks down against you. So anyway, what happens? We got our tick. Just under $90 for what was effectively a 20-second trade. Now, I wasn't just turning the market on and turning the platform on and then trading for 20 seconds. Obviously, I'm sitting there watching it. But one other thing worth mentioning is, when do you actually put the target trade on? Well, remember, you're trying to get into the market when the odds are very high that it's going to tick up, where there's little evidence the market is getting weaker. But we don't necessarily want to have the target placed automatically when we get a fill. So I know there are automatic ways to place a target on Ninja ATM strategies. I'm suggesting you shouldn't use that, because it's possible that while you're waiting for your correlated markets to pop, or while you're waiting for your fill, all of the other markets start marching up. You get a real pop on the other markets. And in that case, you might just want to wait a short while after you get filled to see if your market does the same. So even if you're just generally trying to catch the spread, there's going to be times when you've got your bid in, everything starts to move up. You're not going to put your target at one tick, because there's a really good chance you're going to get more. But again, you'll only be able to do that if you're experienced in that market. So if you feel there is more volatility, then by all means put in a wider target. So just like the way we handle entry, just like the way we handle stops, you make an assessment of how the markets are moving, and you use that to make adjustments as necessary. So most likely, you will start off with a one tick target 100% of the time. And then over time, experience will tell you that there's sometimes a little bit more on the table. And by the way, this one tick thing is not a hard rule. So you'll find that on markets like DAX and crude, that these opportunities give you 2 or 3 ticks. Certainly for crude, it's hard to see how you can profit from one tick, scalping given the tick value and the commissions. So the bottom line is that you really don't care about predicting where the market's going, where it's going to turn, where a pullback will end. You're just looking at what it's doing right now in the moment and playing that as long as you don't see risk. So you might be long now and out of that long trade in 10 seconds, and then 30 seconds later you could be short. So with this trade, we're already way out of many traders' comfort zones for a couple of reasons. So buying at the high, not using a hard stop. But like I said, This is just a different type of trading, making decisions for different reasons in a much smaller time frame. Now let's look at a thicker market and also some inverse correlation. So this is Eurex. The leftmost market is the bubble, which is kind of the Eurex equivalent of the 2-year. Then we have the Bund, which are both interest rate products. Then we've got Eurostoxx 50 and the DAX, which are both stock indices. Now, as a rule, we generally see an inverse relationships between interest rates and stocks, although that rule can break down for extended periods. Now, the reasons for this are kind of beyond the scope of that webinar, but there's plenty online about, those correlations. But anyway, what we're seeing now is interest rates are pushing up and the stock futures are pushing down. So we can see quite clearly that size is hitting into the bids on the way down on the stocks and hitting into the offers on the way up on the bond and the bubble. Now the DAX itself is so thin, it's kind of hard to determine size, but a thin market can really help you with direction. So we have clear downside momentum on stocks at this moment in time, and that's supported by the correlated market. So we can see here the bidders are pulling out of the way on the stocks. I've got 695 contracts pulled from the bids there. And we can see I've already attempted to join the offer at 29.38 and it's gone past me. So at this point, I'm offering 29.37 and about to cancel the offer at 29.38. So to me, thicker markets are a bit more of a pain because a lot of the time you're going to be right, but you won't get a fill. Now you can't chase a market down forever, but as long as you know this market fairly well and how it behaves along with its peers, you can make an educated decision on whether it's good to keep bidding or offering that market as it moves away from you. Now this is the same deal as the last trade, but this time we have more time to make a decision. So there's 431 offers above us and 1,027 above that. So if we tick up, we have some additional liquidity to lean on. So we can see the bids pulling below us to some extent and the offers firming up above us. Now the interest rates aren't coming down, which is good. The DAX has actually retraced a bit, but the thing about the DAX is it's so volatile, it tends to be all over the place. So once again, we're sitting here waiting to scratch trade or take a tick, looking most at the interest rates and a little bit of attention on what the DAX is doing. Now in terms of tick size, this is 10 years a tick, so it's not as attractive a market to trade as say the US Ultra T bonds, but you should be able to get decent commissions. Okay, and then we got a fill on our exit. Now what happened, we were less than a minute past since we placed our offer, got filled, put in our bid and got out of the trade. Now the market hasn't actually moved down. It's still exactly in the same place it was when we got in, but enough contracts traded that we got to the front of the queue and got a fill. So we had our bid to exit at 36, we got filled at 36, and we're still at 36. So in effect, we traded a non-move. The market is still exactly where it was when we got into a trade, and that's common with scalping a thicker market. So that covers 3 different perspectives on capturing the spread. So by nature, it's a higher cost, higher win rate activity, and the main considerations are fees versus tick value and whether you're more suited personally to a fast or slow market. Then it's about learning your market, so you know, is this market acting normally? You know where there's clear momentum, you know when it's a slow and range bound period, and you don't panic if it moves against you a little. So it's not something you do ahead of a news release. It's a trade for certain market conditions on your chosen market. Now, just let me have a drink 1 second. Right, perhaps the most dangerous trend in trading education now is the amount of people telling you to front run large orders. In other words, telling you that if you see a large bid or offer, you just put an order in front of that and you'll make money from it. And this is really appealing because it's basically a one-line set of trading rules. But it's rather silly because it ignores the fact that a lot of the time these large orders are placed in the market to make you front run them so that they can run over you by trading against you. In other words, the large orders are simply other traders trying to fool you. Now, it would be fantastic if it was that simple to sit at the trading screen, wait for a large bid or offer to appear, and then trade in front of it. So no long-term analysis, no need for context, no need for correlated markets, just wait for the magic bid or offer and then press the button to trade. It's just not like that. But front running is a valid technique that you can apply in some scenarios, and like all trading, it's nuanced, and of course, even when you tip the scales in your favor, it's still not going to work every trade. The good part about it is that you have a very clear exit point. After all, if you sell in front of a large offer and it goes past that large offer a few ticks, then you are wrong. But it's not a magic signal, nor is it the shortcut some people claim it make it out to be. So here we are on crude oil, and we can see a large order below us for 531 contracts at 43.20. Now ahead of that, we don't see much. So we got 19 contracts, 24, 27, nor do we really see a lot below it. Now we can see the same thing on the heat map too. So not only is this level, these offers, bids, massive relative to all other levels, if you look at the time at the bottom, you'll see it's been there for about 10 minutes. So it's not a new order that's just popped up. Now, some people will tell you that older orders are more reliable. So let's see how reliable this one was. So as we approach the level, we can see the orders are still there, all on their own. And we can see that still ahead and behind that level, there's not really much going on. So perhaps we are the only ones that can see these big orders, because right now nobody else is front running that order. And we go down a couple of more ticks and all of a sudden that order is gone. They have now got out of the way. We can see they've pulled out of the way, and now we've just got 33 contracts bid. And what happens? We trade through the level, and it takes just 32 contracts to trade through it. So it was totally fake. So if you've been wowed by all that size and bought ahead of that order, you would now be in a losing trade. Okay, but you can front run. So let's look at another example. Right, this time, same day, a little bit later. So you've got to remember, we've just literally ticked through there the 32 contracts. Almost immediately, same things happens again. So we've got 132 contracts at 43.13. If we look above that, we've got 32 contracts bid at the two prices above. Now in the second image, the bids ahead of 43.13 have grown to 60 and 76 contracts. And we can actually see the bid at 43.13 itself has grown a little bit too. So what exactly does that mean? Why is that different? Well, it means other traders are trading ahead of that large bid. We have other people front running the order, or rather, it appears that people are front running that order. Now in the third image, we can see that 50 and 55 contracts traded in to 43.16 and 43.15 respectively. So we are now 27th in the queue with 22 contracts traded at 43.14. We are one tick above the large bid, and that large bid has not pulled out of the way. Now the next image, we can see we traded through our entry price one tick, traded 87 contracts into 43.13, and there's still 69 contracts left. So it's obvious that those large bids were real. There were a lot more signs that these bids were real. And there's more decent sized bids below us too. It's not the 20s and 30s we saw in the last trade. So from a trade management perspective, we have more time to make a decision because there's more bids below us. So we get filled on the trade. And as we move up, what we can see is that bidders are actually following the market up. So we've got 147, 149 contracts below the market. Not a bad thing to see in this situation. So like all trading, front running is nuanced. It's a skill. It takes experience on the specific market you will trade to use it. So it's not this one-line set of rules, see a big bid and buy. So the front run gives us a scalp. It gives us a bounce. It doesn't guarantee that the market will continue forever. So you can use this sort of entry as part of a longer term strategy, or you can just take that initial bounce and then get out of the market, which is exactly what a scalper would do. Now on to the next trade. I call this a mid-leg scalp because it's an interesting trade, because most traders, most retail traders, spend a lot of time watching the market move down so they can buy it, and then as it moves up, they're waiting for a selling opportunity, so they're trying to catch the tops and bottoms of moves. Other traders, probably more sensibly in my opinion, they're looking for a pullback, but sometimes there never is a pullback. But even if there's no pullback and no reversal, there's always trades. And do you ever think about all the trades that occur as the market is moving in a leg or a swing down? So, look at this chart. For most of the time, it was going down, and all that time, there were people selling it all the way down. Not at the high or low, not in a pullback, just smack bang in the middle of a move. And a lot of traders don't see opportunities in the middle of a move because they focus more on charts, and those charts don't define mid-move opportunities very well. In fact, they don't really show the turns that well until they're over. So there's a lot of prop traders that will actually be adding to their positions in a move down like this, scaling into larger positions as price moves down, which is how many people get their biggest paydays trading. So it's not by being right from one entry point, but from adding to their positions as they're proven right. Now, many retail traders will either take the reversal pullback trade or just sit on their hands, because if they didn't get the pullback or the reversal, they just feel like they missed the opportunity. And partly that's because they feel their stop has to be the other side of the turning point, and partly because they just didn't see any entry. So let's go back to Eurex. Here what we have the bund here moving up overall, and the stocks moving down overall. So again, bund is interest rate, stocks is equity indices. Both are at the moment taking a breather, but not in a serious pullback of any kind. Now, I'd have actually preferred to use an example here where the stocks wasn't ticking back so far, but the trouble is when you prepare for a presentation like this, you don't have much choice about the market throws at you, and this is what presented itself as I was getting ready for this presentation. So what we've got effectively is a pause in the action, which may or may not include the market ticking back. But the thing is, although I want to trade the stocks short, it's not really the action in the stocks I'm mostly interested in. It's everything else that is going on. So from left to right, let's have a look. We can see the bobble is mostly trading into the offer. I've got 1,051 contracts traded into the offer by market orders. And on a thick market like this, that's about as good as the market ticking up. So when you're looking at really thick correlated or inversely correlated markets, it doesn't have to be moving in that direction, but if it's trading in heavily on one side, then that's as good as a thinner market actually moving in that direction. We can see the bund is starting to tick up. Not a great deal, but it does appear to be continuing its march up. On the far right, we have the DAX. We all know how volatile that is. We can see it's putting a very nice run down, and finally the stocks. Now, once again, I actually missed the first attempt to short this market at 29.22 and decided to hit into the bids at 29.21 because the pace of selling was really speeding up at this time. The bids were getting really low, and I felt the market was about to break, so I just hit into the bids. This is something called as trying to get the edge, which is basically hitting into a level before it breaks. Now note, they actually sold that before cancelling my offer at 29.22, and that's just a timing thing more than anything. So at this point, even though I've got an offer above at 29.22, I have zero expectation that that order will fill. I've got high expectation the bids will break, so I get my position on here and then I cancel the other order. So overall, I think we're in a good leg down. Market has paused a bit, and now it looks to be set to resume. Now to recap, you don't need to wait for a pullback. Just a pause or an iceberg order, which is giving you some sort of backstop, some sort of decision point. So as long as you're the market, support the trade, you're good to go. But remember, this is a scalp. It's going to give you a bounce, but one where there's a decent amount of short-term momentum. Now, as we proceed, we can see the bobble is still mostly trading into the bid. The bund itself hasn't really done a lot since we got into trade. So when we get into trade, what happens? All these domes recenter and we reset the numbers here. Like I say, the bund hasn't done much. It's not helping us really in terms of confirmation. DAX over on the right is down. It doesn't look like it's down much, but it was at 97 and these domes recenter. Otherwise they'd move off the bottom of the screen. And of course, we can see the stocks has broken down quite a lot. Now, as we move further down, we can see we still don't have these other markets cooperating. The bund and the bobble are not moving up. And we can see the DAX has actually started to tick up. In addition, we can also see we've traded 2,681 contracts into 29.15 and we haven't been able to move down. So we've got an iceberg order at 29.15. The bidders are effectively holding the market. And what happens after the iceberg order? Market ticks up. What else can we see now? The bobble is now trading primarily into the bid. So that's a bearish thing on the bobble. The bund is heading down and the DAX is up. So I've reset the strength meter here on the Euro stocks and we can see we have way more buyers than sellers. So over 6,000 buyers and 3,600 sellers. So basically this trade is pretty much done. So the signs we like to see to get into a trade in terms of other markets are the same things we use to manage a trade. If you take a look at the 5-minute chart on the left for a second, there's not really any significant pullbacks here, but there would be mid-leg opportunities to enter all the way down. So it's just a matter of waiting for that kind of moment for all the markets to be cooperative and for you to get some sort of pause. And a lot of longer term day traders actually benefit from watching the middle of the moves for opportunities like this. After all, you're going to be sitting in front of the screen anyway. Okay, so the last trade that we're going to look at is scalping volatility. Now, this is a very volatile market. We've all watched markets move around. They don't go in a straight line. And we know that some markets are a lot more volatile than others. So DAX, crude, gold, natural gas, some of the agricultural products can be very volatile instruments. And many traders see this as something that works against them. After all, it's really hard to get precise entries on longer term day trades on a market that moves around so much. So you have to put up with a lot more heat on a volatile market. But the thing is, that volatility also represents opportunity. After all, it is quite predictable. So you would not expect crude oil to move down a tick at a time, just 1 tick a minute, and only pull back a maximum of 1 or 2 ticks on the way down. Any reasonable predictable market behavior can be taken advantage of, and volatility is fairly predictable market behavior on markets like crude and DAX. So what we're going to look at is taking advantage of a counter trend spike in an intraday trend. Okay, although you can trade volatility in range bound markets too. We're just not going to go over that today. Now, if you trade this way well, you will end up putting in a lot of bids and offers, and the market will move away without filling them. And that is just the nature of scalping in general. So what do we see here? We have the stocks moving down, the bubble and the bond moving up overall. Now, I'm no expert in the DAX. This took me quite a few attempts to actually get an offer that got filled. Because as a starter, I was basically putting the offers too far from the market. So what have I got? Right now, I've got an offer that's 10 ticks away from the market in a market that's going down. Now, once again, it's just a matter of experience in getting to know a market where you actually place these bids and offers and when you cancel them because you feel it's no longer safe. But the fact is, overall, right here, right now, this moment, the stocks and the DAX are pushing down, the bubble and the bund are pushing up. I'm not that bothered about what they were doing an hour ago. I'm not that bothered about what they will be doing in 20 minutes time. Just that right now, if the DAX spikes up and the other markets, favor or kind of point towards the indices continuing down, that's an opportunity. Now, I ended up moving my offer up a tick and the market did spike up and I got filled at 207. And the market went actually, as you can see, the market went through me and traded a few ticks through. Now, once again, I've got no stop loss in this market. Now I could put in a safety stop way above, but as we said earlier, if you know your markets and you know the other markets are cooperating, you're not going to go into blind panic because an extremely volatile market swept you into a trade and slid past a few ticks. Plus, if you look at where we are, we do have an offer at 209, but we've only actually traded 208. Sorry, the offer's here, 209. We've only traded 208. So what we're seeing here, we've traded as high as 208, but the spread's widened a little bit. There's no evidence that there's buyers up there. And if you look at the trading on the way up, as we spiked up, just mostly ones and twos. That's how many contracts it took to get through those levels. So it's a little bit one-sided, but that is to expect on the DAX if it's moving up just one contract at a time. So basically what we're seeing is a spike up on low volume. Now on the way down, we see a similar one-sidedness, but the bottom line was the markets were moving down. Our related markets didn't give us a reason to not take the trade. Okay, so if the markets had slowed down and started ranging, or the markets had made it look like the indices were going to push up, we would have cancelled the offer. Now we put in an offer far away from the market to allow us to get swept in on the off chance of a spike up. We got the spike up, other markets weren't indicating the reversal up on the indices, so we stayed with the trade. Now like I say, it actually took me about 6 attempts over the space of an hour before finally managed to get a fill on this. So I'm not comfortable trading the DAX, and so I was erring on the side of caution and put my bids and offers way too far from the market. Which brings us to another point. How do you go about trading or practicing techniques like this when getting filled at a bid or offer is such a key element in these strategies? Because you can't trade a sim account on most platforms because the fills aren't realistic. But the good news is that some providers such as CQG do actually provide realistic simulated fills on their demo account. So if you get a demo account with CQG, you will find the fills are actually very close to what you'd get in the real market. Now, of course, there are many more scalping techniques. The ones you've seen today all kind of fit into the area of market making techniques. So they probably seem like very unnatural trades to most chart traders. And I specifically chose examples that many traders would think, I really wouldn't want to buy there, or I really wouldn't want to sell there. And that's quite true if you plan to hold the trade for any length of time, but the game completely changes when you're just looking for a tick or a small pop. So I hope I've given you some idea of what scalping involves. This is very much trading in the moment, that your bias can change from minute to minute. That a lot of the elements we use to make a trading decision for longer term day trading are really not relevant. For example, I use swing charts for longer term day trading and cumulative delta, but I would not use them for scalping. In fact, they would probably hurt me more than help me. Now this webinar would not be complete without mentioning two distinct philosophies I've observed by successful scalpers when it comes to trading around size. So by size, I am referring to times when a lot of large orders are coming into the market, or an area where we get to an area and we stick at one price and trade a lot of size. So philosophy number one says don't get involved when there's size in the market, because you can't take on the big guys. You don't know what they're doing and it could go against you badly. So saying you're better off trading against retailers at relatively quiet times in the market. The other and opposite philosophy is that these areas actually give you a lot of liquidity to get in and out. So for areas where we stuck trading a lot of size, it's often quite predictable where that's going to happen, and the fact that you stay there allows you to actually sit there and get the spread. So on the one hand, you could be playing a game of making a market when things are quiet, effectively picking off retail traders. Alternatively, you could be waiting for the market to get crowded so you can take advantage of the specific action that takes place at that time. Now the fact is, the market will often rotate around a major level in the short term, regardless of whether it holds or not. So that can give you the opportunity to throw a little more size at the market while that area is being resolved. Now both philosophies are correct, but this is something to consider that we haven't mentioned so far. The amount of participation will change throughout the day, and depending on the techniques you're using, you might need to stand aside when the amount of participation changes. Now would be a good time to enter your questions. I would just like to thank and give credit to a couple of people that have kind of helped me on my journey with scalping. John Grady at No BS Day Trading, Rob at Discovery Trading, and Gary Norden at Organic Financial. Also a guy called Guy Bauer at Bauer Post. If you look at Guy Bauer's YouTube channel, Guy Bauer is actually, he's not a big retail trader guy, but he's been the trainer at a prop shop in Australia for quite a long time now. He's actually, I think he's training at a different prop shop. I think he's trained at Genesis now. These three people have had the most profound impact on my understanding of scalping. Now, scalping is not for everyone, but it is really good to know who is on the other side of your trade. So it's my opinion that everybody should understand scalping to some extent, regardless of whether you try it or not. Now, for matching algorithms, this video at the CME is the most comprehensive on explaining exactly how they work in terms that anybody can understand. As for the software you're seeing on the screenshots today, it's all been from Jigsaw Trading, as I'm sure you all know. If you go to the Jigsaw site, you'll see there's a lot more free educational material there. The tools are available on a risk-free trial basis, and we have a large community of traders using the tools. So there's lots of blogs, YouTube channels, as well as our own free chat room that you can use as resources to develop your skills as an order flow practitioner. So let's go over any questions you might have. Steve, do you want to field the questions?
Sure, I'll be glad to do that. Can you hear me effectively over there?
I got you loud and clear, Steve.
Okay, very good. Okay, so we've had a number of questions to light that actually many of our people in the session have been chatting back and forth, answering each other's questions. And as you were entering into some of these trades, they were basically asking, why doesn't he do this and why doesn't he do that? Essentially, let me scroll down here to some of the best questions we've got.
Well, I guess the answer to why don't you do that and why don't we do this and why don't I do that? It's basically just using very specific techniques. So there's no real answer to why you don't do something a different way. It's just basically you're not trading the way you think the market's going. You're trading what's happening right now, and that effectively dictates what you do as a scalper.
Okay, and so essentially we had a question from Chris Wagner, where he was asking, hi Peter, one could safely assume that most top step funded traders are trading oil, crude. That being the case, what markets are they correlating to? Or is oil an outlier?
Yeah, it is a bit of an outlier. Oil is one of the markets that doesn't have really good correlations. Natural gas is a correlated market, obviously, because obviously it's an energy product. Currencies, crude does have a relationship between the currencies, but again, it's not that reliable. What you can do, though, is look at some of the spread markets. There's a lot of calendar spreads on crude, which can kind of help you as well. But yeah, crude isn't the greatest, but definitely it's still a market you can scale. But natural gas and currencies are about the best ones in my opinion.
Brian Watt was making some comments that since if crude is a little too volatile on a given day, but I want to trade crude, I will trade 6C instead, because I'm still trading crude by proxy.
Yeah, exactly. You're not trading the market, you're trading the amount of volatility. So, if crude speeds up, then the 6E, which is normally too slow for you, will also speed up and it will act more like crude. So yeah, absolutely agree with that. You're trading really the volatility more than anything else.
And then Ed Brock was asking, there are 6 columns of numbers in the center of the dome. Which, in your opinion, is the most important to watch when scalping to ascertain short-term trend?
It's not the columns themselves. It's the moves. It's the way the markets are ticking up and down effectively. So I wouldn't say that any specific column was the best. I'd just say it's the way they're moving. So a lot of it is just a way, you watch it. So sometimes you'll be watching the markets and they'll just be milling around. Each market's just ticking up, ticking down, and just really, not doing much. And then everything breaks. And all of a sudden everything's moving in one direction. That's really what you're looking at more than the columns themselves. Now, if I had to pick the columns, I would say it's the current trades column that show you what is trading on each side. So the amount of contracts that are trading on each side is much more important than the bids and offers.
Okay, I hope I'm saying this name right. Schema Harvey is asking, does Peter sometimes use market orders for scalping?
Yep, the last trade on Eurex that we did on the Euro stocks, that was actually a market order. So sometimes what you'll do is you're going to miss if you put in a limit order. So what you do is you just put a market order in. Let's say you've got normally 500 bid, and you want to sell, and the bids go down to 4, 3, 2, 1. You can put a market order in then, because you believe the bids are going to break. And what will happen sometimes is you'll put them. What you actually do, it's not a market order; it's an actionable order. You'll put a limit order to sell at the bid price, and then what you'll do is you'll get filled on that, and immediately the market will tick down, and suddenly you're in a break-even trade. So yes, absolutely, you can go in on a market order. But generally speaking, it's to try and get the edge. It's because you think it's about to break.
Okay, and Faisal was asking, what is the minimum size of the trade you recommend for a person who wants to scalp?
One lot.
In the treasury market.
Start with one lot. Don't start with any more than one lot. But the treasury markets, you can go 50 or 100 on some of those markets. But I definitely just start with one lots.
Okay, and then Marijan is asking, Peter, hypothetical scenario.
Mm-hmm.
Market moves up with 100 contracts on buy side, with 5 ticks and 10 contracts on the sell side.
Mm-hmm.
On the 6th tick, 1,000 buy contracts are traded. Is that a good place to buy the market with no other information available?
No, because for me, no. I mean, because what you're saying there is that if it's taken 100 contracts to tick up through each price, and then you see 1,000 contracts trade at one price, but the market doesn't tick up, it means the sellers are absorbing. Generally speaking, you want to stay away from that. If anything, you'd be looking to short that. But really, like I say, that philosophy about the crowded areas and non-crowded areas, you're probably better staying away from that, for the time, unless that's your specific speciality.
Now, Arnold was asking, what is a typical realistic monthly profit in points or ticks scalping FESX?
Well, the stocks is that's the thing. I mean, that it's a very difficult question to answer because it just depends on your account size.
He's really asking FESX.
Yeah.
He's really asking FESX versus ES. Actually.
Yeah. So first of all, it's a difficult question to answer because it depends on your account size, right? And but FESX, you can trade a lot more size. It's a lot more thicker. ES, it's a lot more volatile. I don't think there would be a big difference, to be honest. So with the ES, you're going to get more trades a day because of the volatility. FESX, you're going to be able to throw more size at it. I wouldn't say there's a difference in terms of profit potential. Although it's got to be said, the Euro stocks is a lot more popular with scalpers than the ES. I think it's just more down to what kind of market suits you.
And then Faisal had another one. Should I use cumulative data for scalping, or does it render it useless?
Okay, I'm going to presume you mean cumulative delta there. If I say, yeah, I would say it's completely useless. It's a longer term trading tool. It kind of tells you more about overall direction. But I think for a scalper, really, you can be short, long. And the cumulative delta will keep you on one side. So for me, I wouldn't use it. It really is in the moment.
Brian was asking, do you ever take a second trade adding to the loser to get a better average when the market gaps bid against you, or do you just work your way out fast as possible and take the loss?
I just worked my way out. I've never had any luck adding to losers.
Oh, Dennis had a question about latency. Okay, let me go up and find that.
It's okay. I can just talk about latency anyway. Okay, so I know somebody who can trade crude from Australia, scalp crude from Australia. If you look at some of the trades and some of the markets, if you were trying to scalp at the inside on crude, you'd have a little bit more trouble if you're in Australia because your latency is probably going to be 350 milliseconds, right? So you're a third of a second behind, but it's not a huge amount, to be honest. Things like the trades where you're just basically making the market. So basically a market with downward momentum that you just follow down, putting in offers, trying to get a spike against. Latency is not going to affect you there. So really, in a thicker market where you've got a lot of bids and offers, latency isn't going to affect you so much. So really, if you've got a lot of latency and you're trying to play very close to the inside of a thin market, that's when it's going to affect you. But you just have to stay away from that if you're very far from the market.
Okay, and then we had one question specific to the tools. Just 1 second, let me pull down to that. Can Jigsaw work by itself with a data feed or only through the platforms on your site?
Well, that's a good question because we just released a new version of Jigsaw called Rapid Trader. So we have actually got a standalone version of the product. It's in alpha trial now. Any existing customers have got access to that. But yeah, basically we've got a standalone product. Works with CQG, Rhythmic, and IQ feed right now, and we will add other feeds later.
Okay, and I think that's about wrapping up. Let's see. Ed had one more question. Is pace and size of contracts being added or subtracted to a bid and ask side? I'm sorry, let me start over. Is pace and size of contracts being added or contracts to bid and ask side in contrast to one another? Valuable information to discern short-term trend.
Okay, it's one of the things that you see. It affects the next tick. So if you look at if there's a lot of bids being pulled and a lot of offers being added, generally the next tick's going to be down. Okay, generally it's not going to work every time, but we used to have this drill. I used to teach this drill to people, which is basically guess the next tick, and basically just sit there and decide every time the market moves. You can do one of three things. You can say it's going to tick up, it's going to tick down, or don't know. And so basically, sometimes it won't be clear. Sometimes you'll just see all the bids pulling out of the way, and they say, right, that's going to be a tick down. Sometimes you'll see all the offers pulling out of the way, that'll be a tick up. And basically what you do, you just write that down and have it how many times you're right. And you can be like 70 or 80% right, right 70 or 80% of the time doing that. Now, don't get excited about that, because at the end of the day, by the time you know that the market's going to break one way or the other, generally speaking, it's too late to put in a limit order to get filled. But you can put in an order to get into a break even position when that move occurs, when that tick occurs. So it can help you with the next tick. It is a good exercise to just watch that and play like a predict the next tick up, tick down. And yeah, absolutely will help in trading.
Okay, let's wrap up with Cedric's question. How many months of observation would a beginner need to master these kinds of techniques?
It really depends on the person. What you'll find in a prop shop is prop shops will tend to take people who've never placed a trade, don't have any experience in the markets, and don't know what dome is. And they will sit there, and they prefer that because they've got no bad habits to kind of unlearn. So they can take somebody brand new, fresh from college, never placed a trade before. They generally put them through a training program of 12 weeks. At the end of 12 weeks, and obviously through that program, they're actually trading on sim. Some people go live after 12 weeks and are profitable, but they'll make sure they get profitable on a demo account first. So 12 weeks in a prop shop is kind of about the minimum that they'll let them get on. Now, obviously, if you've already been reading the dome for a while and you've got some experience, reading order flow, the chances are you can get a lot quicker. But I still think you'd be looking at first time as a scalper, a couple of months realistically to start, really knowing if this, start really making money at it. But you're doing that because you're getting a lot of experience, a lot of trades per day, basically. So Adrienne, I think we're done. We didn't send you to sleep, did we?
Thank you much. People enjoyed it. I enjoyed it. So we'll see you again in 6 months.
Thank you, Adrienne, and thanks all for listening.